Please ensure that you fully understand the risks or seek independent advice if necessary. UBCFX provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. And make sure you visit the UBCFX education platform when you go to www.ubcfx.com. Now, tonight's class is being recorded, and if you wish to see a recorded version of this class, you can do so in about 24 hours by using the same link used to attend this evening, or once we've had time to clean it up and edit it, you'll be able to find it on investing.com under the education tab and then look for webinars on demand. So let's get started talking about candlesticks. But before we do, I want to make some explanations about tonight's class. I'll use the term security when referring to tradable financial instruments, but I might say Facebook, I might say the euro, I might say Bitcoin, but I'm still referring to all tradable financial instruments that are traded in an open marketplace. I'm not talking about a specific asset. This gets very, very boring saying security, security, security over and over again. Same thing with, I intermix the terms of investing and trading. We're all here tonight because we're all want to be traders. We know investing is a much longer term proposition. Now, whenever I'm giving a seminar or a class or making a personal appearance, the first thing people ask me is, what should I buy? What will the price of this be tomorrow? Where's it going? Should I buy gold today? Should I buy Bitcoin today? They ask what will the prices be tomorrow, next week, next year, an hour from now. Well, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball. I don't have a Ouija board. And anybody who tells you they can know what the prices are going to be are full of BS. Price action is the only thing that dictates price, and nobody can predict what's going to happen to it. But if we use technical analysis properly, we can filter out all the iffy trades and find a trade where the markets are acting in an intelligent fashion that we can decipher. And technical analysis will help you with that. And so will candlesticks. Now, before we actually get deep into tonight's class, I'm not apologizing, but I will if something goes wrong. PowerPoint has added a new feature into their technology, which allows me to actually insert into my PowerPoint presentation some pre-prepared creative presentations. And tonight will be the first time I've ever used it. I've tested it a couple times, but tonight's the first live class I'm doing it in. It is a little bit technical, but it will be quite unique because it lets me give you a pre-made short little presentation that I can talk over with and talk to you about while we're watching it. I'm not 100% sure it's going to go smoothly. So if it doesn't, I'll get it all fixed and you won't miss anything. But I'm explaining it now. Now, also, if you look on your screen, I've prepared three handouts for you. There's the candlestick cheat sheet. There's the introduction to technical analysis guide from investing.com. And then there's a little handout on reading financial charts. Because Japanese candlesticks are ultimately a financial chart or a way of charting. Now, candlesticks, so please download those now because you can only get those during the live class. So just click the download button. There's no registration, there's no anything. Download them on your computer, open them at your convenience. They make great reference guides. Use them whenever you want. Now, candlesticks have been around since the 17th century. And they came to the Western world much later, not till the last 100 years, but they still weren't even used until much more recently, until we actually got computerized charts, because they were a little bit complex to do hand charting. When I started trading 40 years ago, we charted everything by hand. Now, a candlestick is made up of 4 pieces of information. And we have to understand what this candlestick is made of and how it's put on the chart before we can start actually interpreting them. So whether you're using a 15-minute chart or a 2-hour chart or a 1-day chart, you start out with a candlestick by placing a line across at the open. So if we're using a 15-minute chart or let's say a 1-hour chart, at the beginning of that 1 hour, we put a line across. At the end of that 1 hour, we put a line across at the price of that 1 hour. We then connect these two lines together. We then put a dot at the highest price that asset reached and a dot at the lowest price that asset reached, and we connect these dots to the lines. This is known as the body of the candlestick. These are called wicks or shadows. So ultimately, we see the lowest price of the asset, the highest price of the asset, the open price of the asset, and the close price of the asset. Now, if we stepped down from the open to the close, that would be a bearish session, or we would color that candle in with red. If we stepped up from the open to the close, that would be a bullish session, and we would color that candlestick in green. But the fact is, we use red and greens today, but you could use chartreuse and orange. You could use pink and purple. You can use God knows what. Okay? Because as long as you know which color is your bullish and which color is your bearish, it doesn't make a difference. Because in the old days, when we didn't have computerized charts, when we were charting by hand, we're sitting there in the pits getting the prices off of the ticker tape, and we're drawing these onto our graph paper hand by hand. But you're not running around with an envelope full of colored pencils. Didn't have magic markers back in the day. So in those days, we had black and white candles. When it was a bearish session, we would just use the side of our pencil and fill in the candlestick. When it was a bullish session, we would just leave it hollow. The reason I'm telling you this is today, all the charts are using greens and reds or whatever color. On some brokers' charts, you see they're using their company colors. But they're all adjustable. The charts will let you change into whatever you want. The reason this is important to remember is that a lot of the literature and even some of the names of the positions come from back in the old days. So you have things like 3 white soldiers and 3 black crows. So 3 black crows could be technically today 3 red crows, but you don't change the name. So historically, it's 3 black crows, 3 white soldiers. There's evening star and morning star because they look like stars in the black and white system. They don't look like stars in the red and green system anymore. But just so you're aware of it. Now, a candlestick chart and a bar chart are relatively the same. Let's go over to a live chart and take a look. Okay, here we're looking at the chart, the Euro-US dollar. A bar chart uses the same pieces of information. It uses the open, the high, the low, and the close for the period. A bar chart just doesn't give you any bodies of the candle. It doesn't give you wicks. But it uses the same pieces of information. Now today, you could even color your bars. So you can make your bars red and green. A lot of people do, a lot of places do. I turn them all back to black immediately. But you could have them red and green. But most people today, most online traders today, are trading with candlesticks. One of the biggest problems is everybody looks at a chart and sees lots of red or lots of green and thinks that's telling you to buy or sell. That's far from the truth. It's far from accurate. Candlesticks have very little to do with reds and greens and the accumulation of reds and greens. Candlesticks have to do with the body, the wick, the position, and the reaction to the previous and the preceding candles, and its relationship to the trend line. So there's actually a name for this movement right there. It's not a very common happening, but when it happens, guess what it's called? We talked about it. 3 black crows. But that's kind of an obvious thing of what's going on right there. But candlesticks are all about the relationship between two candles, the size of the body, the length of the wicks, and its position next to, or its combination of preceding candles. Okay. And you have things like bearish engulfing candles, bullish engulfing candles. None of it has to do with seeing lots of red and trading something to go down. Happens to be this time period that held true, but on the whole it doesn't, because this and that candle combined tell you the market's going into a period of indecision. Now we can see what happened. Broke traders were totally undecided. Same thing here. But these are things called doji. We have harami. We have marabouzo candles. They're marabouzo. They're all different shapes and size candles that tell you something about the market. So before you can trade using candlesticks, you need to learn what the market's trying to tell you. So what does the size and the shape of a candle tell you?
Candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to 2 simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. Candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to 2 simple things. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement. Candlesticks are the best way to visualize the ups and downs of a price, so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and 1 or 2 tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest. They're easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals charts are so popular? They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal. The change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish. These show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish red candle followed by a bigger green one which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This candle's a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that make the pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for a shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point.
So there are a lot of things that candlesticks are trying to tell you. And now you're probably sitting there so confused. And so how am I going to learn all these? How am I going to master all these? Well, let's start out with the easy stuff. The first thing is an individual candlestick tells you about the battle between the bulls and the bears. So there's basically 6 overall explanations. It's a long white candlestick, or today a long green candlestick, with equally sized highs and lows, shadows. That tells you the bulls were in control during that session. The bears had a little bit of a run pulling it down to low, but the price closed near its high, and so the bulls control. The opposite is true in number 2 with the bulls. Then in 3, 4, 5, 6, we have small bodies. These are signs of less decision, less control. And then we can see what happened with the wicks. So number 3 are very small bodies with small wicks. It's telling you there wasn't much activity and the traders are sitting on the sideline. 4 and 5 is the opposite. There was a lot of either bulls or bears, but they had no momentum. They were able to push the asset down or up for a second, reach a new high or new low, but they couldn't hold on to it, and an asset ended up closing where it started out. So Before turning to from single to multiple candlestick patterns, there are a few general guidelines to cover. But now they have the basic idea of what candlesticks indicate with their bodies and wicks. Let's take a look at some simple, uncomplicated patterns. We have one candlestick patterns. They don't really tell you much, but they give you some information. Those are marabouzos, spinning tops, dojis, hammers, hanging men, inverted hammers, and shooting stars. Now, if you look at the cheat sheet that I gave you in the handout, these are listed on there. Now, there are a total of 32 patterns or primary patterns for candlesticks. 16 of those are the top patterns that you should know that give you strong indication of the market. It goes out to lots and lots and lots more. And different traders have come up with some type of 4 and 5 candlesticks together, but they're not part of the standard candlesticks. There are 32 prime types of candlesticks and 16 of the most important shapes and positions. And they're on that cheat sheet, that looks just like the one that I gave you. But some of the basic single candle patterns that you should be aware of are single candlesticks are the doji and the marabouzo. A doji simply looks like a cross. In the old days, the interpretation of doji is the open and the close had to be the same. But in the old days, the markets were slower and they traded in larger increments. Today, it's got a slight difference that the open and the close have to be almost the same, because now that we're trading in pips and we're trading currencies that are trading 4 decimals to the right, the chance of getting an open and close exactly the same are not so often. But getting a difference of 1 pip between the open and the close is quite common. So the definition of doji is it looks like a cross. But once you get away from a little bit of a body and go a little bit farther, it's no longer a doji either. And dojis can have long tails in either direction. But a doji you have to look at is where it appears. Now, it shows market indecision, but you need to look at where a doji appears in relationship to the other candles and the trend, because dojis appear quite often. Then we go to marabouzo. Marabouzos happen often, but they're quite unique, and they're very important. I like using marabouzo. What do you see about the marabouzo here? It's got no wicks, no shadows. That tells you here that the bulls were in control from the beginning of that session and closed all the way at the high. The only reason the session ended is time ran out. That means most likely it's going to continue in that direction in the next session. The opposite is true in a bearish marabouzo. Then we come down to haramis. Haramis are quite popular. Harami in Japanese means pregnant. And the explanation for a harami is it's a candle of one color. It doesn't matter which color. And the next candle is fully engulfed inside the body of the previous candle. Not above the body, not below. That the wicks and everything of the current candle is inside this body. So if you imagine a pregnant woman, the body of the baby is fully incorporated in her body. It's not up in her head and down her legs, it's within the body. So when you get this in it, the rule of thumb is this candlestick, the current candlestick, must be of opposite color of the previous candlestick, fully uncovered. And that's telling you that there's a reversal. It can be the opposite direction also, and that's a bearish pattern. But you have to, again, see where it is in determining the trend. Then we go into all the other elaborate candlesticks. We even go into blending candlesticks. But two of the primary candlestick patterns we talk about all the time are bullish engulfing and bearish engulfing, like you saw in that short presentation. We're going to look at a little other presentation. We're going to talk about them again because they are the most well-known and most popular. So let's explain these.
Using candlesticks in conjunction with each other can indicate market sentiment by highlighting a shift in power between the buyers and the sellers. Candlestick patterns can therefore provide signals such as a reversal of price action. An engulfing pattern is a strong reversal signal made up of two candlesticks. There are two types of engulfing patterns, a bearish engulfing pattern and a bullish engulfing pattern. There are three main characteristics for spotting these patterns. The market must not be ranging. There has to be an uptrend or downtrend preceding the pattern, even if it is short term. Secondly, the body of the first candle must be smaller than the body of the second candle. It is not necessary for the second body to engulf the actual wick of the first candlestick, although this does create an even stronger signal when it does. And finally, the second candlestick body must be opposite in color to the first candlestick body. For example, if the first candlestick is bullish, the second candlestick must be bearish. Let's have a look at the characteristics of a bullish engulfing pattern. You can see in this example, the market is in a downtrend. Notice the highlighted area where the first candlestick of the pattern is bearish, shown by its orange color. The second candlestick in the pattern is bullish, indicated by its blue color, and engulfs the body of the preceding bearish candlestick. These characteristics signal the reversal of the downward trend to the upside and demonstrate how the bears were overpowered by the bulls. Let's now have a look at the characteristics of a bearish engulfing pattern. You can see in this example, the market is in an uptrend. Notice the highlighted area where the first candlestick of the pattern is bullish, shown by its blue color. The second candlestick in the pattern is bearish, indicated by its orange color, and engulfs the body of the preceding bullish candlestick, signal the reversal of the uptrend to the downside, and demonstrate how the bulls were overpowered by the bears. Tweezer patterns are formed by two candlesticks that have matching highs or lows. As the two wicks have the same height, it has the appearance of a pair of tweezers. A discrepancy of a few pips is acceptable. There are two types of tweezer patterns, a tweezer top and a tweezer bottom. As with the engulfing candle patterns, there has to be an up or down trend preceding the pattern. The market must not be ranging. Tweezer tops are formed by two candlesticks that have matching highs and can help spot a trend reversal. You can see in this example that the market is in an uptrend. The upper wick of the first candle shows signs of the buyers losing momentum. The upper wick of the second up and then being overcome by the sellers. The wicks are of equal length and the highs are at the same level. These characteristics can signal the reversal of the uptrend to the downside and demonstrate how the bulls were overpowered by the bears. Tweezer bottoms are formed by two candlesticks that have matching example that the market is in a downtrend. The lower wick of the first candle shows signs of the sellers losing momentum. The lower wick of the second candlestick in the pattern represents a second attempt by the sellers to continue pushing price down and then being overcome by the buyers. The wicks are of equal length and the lows are at the same level. These characteristics can signal the reversal of the downtrend to the upside and demonstrate how the wicks do not have to be exactly the same size or even in consecutive order. Here we see a tweezers pattern with a candlestick in between. The important aspect when looking for a tweezers pattern is two equal highs or lows, indicating that either the buyers or the sellers were eventually overcome after a trend, indicating a potential reversal. So far you have learned that dual candlestick patterns can indicate a change in trend, but not necessarily an immediate or significant reversal. Using candlesticks in
So bullish tweezers and bearish tweezers have many different types of definitions. I don't use them because I find that they offer too many variables. But when they are well defined and you have very well, beautifully laid out tweezers, then I can find them very reliable. That means where the two candles are opposite color, the highs for both candles are equal and they have equal length lows coming off of a downtrend. That's telling you that that downtrend is over and reversed. Okay. Same thing in the opposite direction, but only the most well-defined patterns. I don't like to use these iffy type patterns, a candle in between. They don't have to be exactly the same because that just leaves too much open to interpretation. Now, there are, like I said, 16 primary and 32 in total different patterns that you should know and learn. And I know you're all sitting there right now saying, wow, how am I ever going to do that? Well, now that we've gone through these various candlestick patterns, either you're ready to go to trading battlefield with your newly acquired knowledge, or you want to shout, stop it. I am too confused with all these funny names and shapes and can't remember any of these. Well, the fact is, you don't have to memorize any of these. And today, computers have made all of this a lot easier. There's all types of scanners out there. And all you have to do is understand what the pattern is trying to tell you. Okay. So let me pop up. Okay. So right now we're looking at the live chart for the Euro US dollar. I could go through here and spend hours trying to find patterns. The fact is, the only patterns that are going to help us make any trading decisions are right here. Okay. Now, as the asset had moved through, we want to be able to see all these. But who wants to spend all of that time? And most of you guys are trading tons and tons of assets. Well, today's life is a lot easier. If we go up here, like on TradingView to indicators, go over here to public library, we can scroll down here and we're going to find a nice little script that identifies candlestick patterns. We're going to click on it. And lo and behold, look at that mess I have on my chart. Because now it's identified all the different candlestick patterns. Put it on my charts, put it all over the place. But I can use my settings and get rid of all the ones that I don't care about. I don't care about evening star, morning star, shooting star. I don't trade hammers. I don't trade inverted. I don't. Haramis I use, bearish and bullish, engulfing. Pure lines I don't use, belts, kickers, don't use, hangmans I don't use, dark cloud cover I don't use. So guess what? I've gotten rid of most of them. But we end up with tons of stuff on the charts anyway. So we can go back and then determine where we want it. So we can say dojis, which aren't so important, just give us a little star. Okay. Shooting star, I don't even want a shooting star. Inverted hammer, I don't care about. Harami, let's just make it in gray. And let's just give me a little cross. Okay. Bullish harami, I'll do that one in gray, also darker gray. And give me a cross here also, because I'll be able to tell what it is. And so my bullish is below, my bearish is above. And I can set these up for all of them, and then instead of having all this mess all over my charts. See? Now I just have a dot. I can then get rid of the text and just have dots, squares, diamonds, and I just have to see where they are and read them. So you can customize it to fit your trading. Then you don't have to be using TradingView charts. You can just use these to tell you where the pattern's appearing. We have a harami right here, and then put it on your chart, but you don't have to spend your hours searching for it. That's one way to do it. We can also find that investing.com is given us a free cheap scanner that works quite well. Go to the Euro US dollar on investing.com and click on candlestick patterns. Pick the time frame we want on the chart. And lo and behold, it's going to highlight for these for us whenever they're on our charts. And also they're going to put them down below. And we can then customize what we want to see. Like, I don't care about 1 day patterns. I don't care about 1 hour. I want full recognition. I only want the top patterns. And I can then apply it. And as they're developing, they'll put them right here. All customized to exactly what you want. And then you can transfer them onto whatever trading chart you're using. Or you can go over to under their technical analysis heading and go under and click on candlestick patterns. And then you can set up a whole scanner for yourself. Pick the assets you want to trade, you want to watch, pick the type of candlesticks you want to see, what you want, completed patterns, emerging patterns, bullish and bearish, what you want to see. I've set up the assets I mentioned. And what it's going to do is going to tell you right away, here's our emerging patterns. In Bitcoin US dollar, we have a bullish engulfing pattern that's currently developing right now in the 1 hour chart. We also have a falling 3 methods pattern in a 15-minute chart that's currently developing right now. Not sure what it means. We can click on the line and it's going to explain it to us. And if we want to click right on the asset, it'll take us over to the chart to see everything that's happening. We can see completed patterns that we just finished 3 black crows in the 30-minute chart for Apple. Just ended 1 time frame ago. For the FTSE, we had 1 hour time frame, but that ended three candles ago. We had a doji star bearish pattern, 3 candles. And again, we can click on the line and see exactly what it's telling us. So we had our 3 black crows, our 3 red candles in a row. That's a very bullish signal. And we can go over to Apple and see exactly what's happening with Apple. So that made life a lot easier for us in finding the patterns. Trading with them and understanding them is a different scenario, but finding them and getting the explanation is a little bit easier this way. Now, I'm going to show you another interesting way that you can use candlesticks just in your decision-making capabilities or your understanding price action.
Now, the core of this strategy relies on the concept of momentum loss, shown through candle sizes and shapes, which is a very powerful price action technique. Here we have the Kiwi dollar. So if you've watched our other videos, we always want to support here, where price hit and reverse from.
Now you can use any method for coming up with support and
resistance. Now here's a very key point you need to know in order to spot high probability reversal trades. We want to see candles getting smaller and smaller as they approach. It shows that price is losing momentum. Very key point. You want price to be losing momentum and slowing down as it approaches key levels. Now, as price approaches this level of support, look at how the candles behave. As you can see, we have a big candle, followed by a smaller candle, followed by an even smaller candle, another smaller candle, and then a smaller long wick candle hitting support. And then finally, an even smaller green candle that is also a doji and also an inside bar, which is a reversal candle. And this results in a bounce upwards. So I'll show you this again on another pair. Here we have the Aussie dollar. This is a key level of support. As you can see from when price got here last, it hit and reversed upwards. So as price approaches this level again, We have a big candle, then a smaller candle, an even smaller candle, which is also rejecting support, and then followed by another great inside bar candle rejecting support.
Now, when we talk about rejecting support, what we see is price fell, the low was way out below support, but it couldn't hold it, rejected. And see where the small body candle is? It's a green candle, but the close is well above that support level. The next candle, the red candle, we see the wick, the low, again going below support, can't hold, gets rejected, and the closes above the support level. So that's what we talk about when we mean rejection.
As well. And as you can see, price bounced upwards, which would have presented a great trade opportunity through the intraday time frames. So when approaching support, what these smaller and smaller candles show is that the sellers and people shorting the market are losing steam, meaning some sellers might be taking profit as they notice this level of support, which causes. Here's the Kiwi yen. As you can see, we have a double top here before price tanked down, making this a key level of resistance. Now, as price approaches this level of resistance again, look at how the candles start acting. We have a big candle followed by a smaller candle, followed by a smaller red hanging candle, another hanging candle, and then a candle where the wick is rejecting this level of resistance before dropping down. Here's the cat Swiss. Again, we have 3 rejections of this level before it reversed downwards, which makes this a key level of resistance. As price approaches this level again, we have a big green candle, a smaller green candle where the wick is also rejecting resistance. And as you can see, price reversed downwards. Now, here's a pro tip. Look for a candle color change at support or resistance, which can signal a possible trend change. I'll show you what I mean. So as price is moving upwards, notice all the green candles. Green candles represent bullish price action. As you can see, there's 8 green candles in a row before finally a red bearish candle appears. And the most important part is that it occurs right at resistance. And as you can see, price then reverses, which you want to avoid. Here's the Aussie Kiwi. As we look to the left, this is a clear level of resistance. Now, look what happens when price approaches this area again. We have a small candle, but then the following candle is a large candle, which shows a gain of momentum. You do not want to see momentum gaining as it approaches these key levels, because if price doesn't slow down, there's a high chance it will break right through these levels. As you can see, there was no price action that signaled a reversal. So I'll show you this again on another pair. Here we have the dollar CAD. As you can see here, we have a double top and then price reversed, giving us resistance. Now look at what happens as price comes up here again. We have a small candle and then a massive engulfing candle, which shows that price is picking up speed and momentum as it approaches its level, showing that people tried entering short, but that failed and price blew right through, which is a mistake that most beginner traders would make, as they would have seen this long wick candle and thought, oh, this is a great short. Be very careful when you see large candles approaching support or resistance levels. So let's jump to another example. Here's the dollar yen. You can see we have a double top here making this resistance. As price comes up and approaches its level, we have a big candle followed by a smaller candle that is rejecting the noise, and then finally a red candle also rejecting resistance before price reverses downwards. Now, here's a perfect example of momentum loss not occurring as it approaches this next level of support. So we look left and see 2 rejections of this level, making it a good level of support. But now, look at what happens when price approaches this level. Massive momentum is picking up, they're still in control, Here's another mistake beginner traders make as they see the small green candle, which is just some sellers taking profit, but it is then followed by another bearish candle before breaking right through, meaning that there was no buy opportunity at this level of support. Look at the difference between what a good reversal looks like with good price action versus what bad price action looks like. Now.
So as you can see, this is another way of using candlesticks without knowing all the explanations, definitions of patterns and everything else. It's not a matter of seeing reds and greens and reds say to trade down. It is a matter of judging momentum and market sentiment, observation and market sentiment. Each candle of a candlestick chart is a reflection of the market sentiment. It is not just the standard patterns, but with keen observation, you can master the art of trading by looking at the charts without even remembering the names of all these patterns. So there's many ways that you can use candlesticks, but it's not something you're just going to look at a red chart and see reds and greens and start jumping in there and trading. So each candle on a chart is a reflection of sentiment. Each candle on a chart may be saying something to you, and how do you listen to it? The answer to that lies in the size of the bodies and the candles and its wicks. So the first step you need to take is learning those primary patterns, the primary names of the candles. The next step you need to take after that is learning what the bodies are telling you. And then you can either learn all those different patterns and employ them, or you can use simple trading methods like we just looked. But candlesticks are best when used in combination with other indicators, such as pivot points and support and resistance. You can trade with candles only, and I'm not really going to give you a guideline or set of rules because it's really a fallacy. Okay? Nobody should be trading with just one indicator alone. But candlesticks should help tell a story of what price is doing. They'll help you find entry points and exit points. Now, traders following candlestick charts are at a distinct advantage. They realize that stop loss points is a function of the candlestick's buy and sell signal itself. You can use candlesticks to determine where to put your stop losses, where to put your entry points, your exit points. But you have to learn how to read those candlesticks first. So whatever trading timescale you work on, candlesticks can be an incredibly powerful tool for helping you to judge what's coming up next in the marketplace. There are many, many more patterns that you can learn to recognize. However, the patterns I've chosen to include are the ones that I find most useful. Candlesticks can be a powerful trading tool, but they are not best used in isolation. Combine them with simple pieces of technical analysis, and they will give you clear signals that the market is ripe for you to open your trade or close your position. Use them alone, and you might find that you are too close to the price picture to see what's really going on. When used in conjunction with a successful trading strategy, I hope that you will find that candlestick analysis will enhance that system and improve its performance. And as you become more and more familiar with candles, you will learn to instinctively read the story that each one is trying to tell you. So on that note, I'm going to say goodnight to everybody. I hope you learned something. I hope you have some things for thought. Remember to download those 3 handouts, and we'll talk to you again real soon. If you have any questions or want to learn more, go to www.ubcfx.com and go to their educational section, or contact them and they'll have a financial analyst sit with you on the phone for an hour and go over this with you hand in hand. So thank you very much for joining us, and have a great trading week. Bye now.